Have you ever felt like just trying to understand the stock market is like you're navigating this, vast and unpredictable ocean?
Yeah.
It can be so overwhelming to know, like, when is the right time to buy, when to sell, or even should I just stay put?
Yeah. Yeah. Definitely a feeling many can relate to.
But that's precisely why we are diving into all this material that you've given to us. You've given us excerpts from different presentations all about market analysis. We've got slides, transcripts, even some, this is interesting, some Thai text in there.
Oh, wow.
So clearly you were looking for a really multifaceted, like broad understanding of how to make sense of all the market's movements.
Yeah, it's fascinating to see such a mix, such a diverse mix of resources. Definitely seems like you're not shying away from really digging deep into this. And you know what? That's fantastic. I mean, a well-rounded perspective is absolutely key. It's essential when it comes to market analysis.
Absolutely. So our mission in this deep dive is to break down all these complex concepts into, more bite-sized pieces, sort of highlighting the most valuable takeaways, the most valuable things for you.
Yeah.
We'll explore how market analysis can really help you identify favorable trading conditions, how to manage risk, and maybe we could even unlock some of those hidden market insights along the way.
Yeah, think of it like building your toolkit for understanding like the market's language.
Okay.
These techniques are like these different lenses through which we can actually view its behavior, and it can really help us make more informed decisions.
I love that. That's a great analogy, the different lenses. Okay, so let's start with a technique called market filter, or you can just call it MKF.
Okay.
So MKF, what is that all about?
So imagine MKF as this sort of like traffic light system, but it's for your trading decisions.
Okay.
One of the examples in the sources that you provided actually uses the SET index, which is the main stock market index in Thailand. And it highlights how that index's 60-day moving average, when it crosses over the 200-day moving average, well, that can be used as a signal. A buy signal.
Okay, hold on a second. For those of us, those who might not be as familiar with moving averages, can we maybe just break that down a little bit?
Oh, yeah, of course. So a moving average, you can basically think of it as like a way to just smooth out price data over a specific period of time.
Okay.
So if you take like a 60-day moving average, well, that would calculate the average closing price of that set index, but over the past 60 days.
Got it. Okay, so then when that shorter-term average you're talking about, when it crosses above that longer-term average, what that suggests is that momentum is shifting upward.
Exactly.
And that can be a signal to buy. Okay.
Exactly. Yeah.
Yeah.
However, it's super, super crucial to remember that MKF, just like any technical indicator, it has its limitations. The sources actually point this out. You have to be aware of, they call them false signals.
Okay.
Right. Just because you have this crossover doesn't necessarily guarantee an uptrend. These are what we call lagging indicators, meaning they're showing us what has already happened. They're not really predicting the future.
Okay, so it's not a foolproof system. It's not a guaranteed thing.
Right. Great.
So what are some ways then to maybe make MKF, I don't know, more reliable? I mean, we don't want to get caught speeding through a red light, right?
That's a great point. That's a perfect analogy. So one way to maybe mitigate these false signals is to combine MKF with other forms of analysis. Your sources actually mentioned what are called ribbon charts. So ribbon charts, they visually represent multiple moving averages all at once, giving you a broader perspective.
Okay, so we're going from traffic lights now to ribbons. I'm liking these visual metaphors. This is good. It helps a lot. It makes these concepts much easier to grasp. But let's shift gears now and go to our next tool, which is market classification, or MKC.
Okay.
So tell us about MKC.
So think of MKC as kind of taking those traffic light signals that we were just talking about from MKF, and now we're adding on a layer of nuance. It's about categorizing the market into these different states: uptrend, downtrend, or even sideways movement.
Okay, so instead of just seeing red or green, we're getting a more detailed, picture of the market's mood, so to speak.
Exactly, yeah. And to help really define these different market states, the sources actually introduce this concept called a market table. So this market table, it's basically a matrix, and it outlines specific market conditions, and it gives us their characteristics. So it really allows us to get a much clearer picture of what's happening but beneath the surface.
Okay, could you give us an example of how this market table, how it works in practice?
Yeah, so imagine you have a simplified market table. It's got two axes.
Okay.
One is representing price momentum, and the other is representing market breadth. And so each quadrant of this table would represent a different market state. Strong uptrend, weak uptrend, sideways market, and so on.
Ah, okay, I see. So by plotting where the current market conditions, where they fall in this table, we can get like a more precise understanding of its current state and then maybe, its potential direction.
Precisely. And the real power of MKC is that it allows you to tailor your money management strategies accordingly.
Oh, okay.
Yeah, one of your sources even suggests adjusting your investment percentage based on the classification. So, for example, you could do 6% for a strong uptrend, or maybe 2-3% for a sideways market, and so on.
So MKC isn't just about like labeling the market. It's actually about using those classifications to make smarter investment decisions, to manage risk more effectively.
Exactly. It encourages a more strategic, a more adaptable approach rather than just reacting to these buy and sell signals, from just MKF.
That makes a lot of sense. Okay. Now the sources also, they introduce some pretty interesting terms related to MKC. And they mention I think they use the terms base market and merge market.
Yes.
What do those mean?
So base market, that refers to individual market conditions like those that are defined in that market table example.
Wow.
But merge market, on the other hand, that involves combining multiple base markets. But you do this to gain a more comprehensive view.
Interesting. So it's like you're looking at the market from different angles.
Yeah.
And then you're taking those different perspectives, those different angles, and you're putting them together to get the full picture.
Precisely.
Okay.
And there's one more term that they use in there. It's MKC0. And this basically just refers to trading all the time, regardless of market conditions.
Okay, now that sounds a little bit like a recipe for disaster to me.
Yeah.
Clearly, understanding these NKC classifications is really crucial for making informed decisions.
Absolutely. It's about knowing when to hit the gas, when to tap the brakes, and, when to just stay parked.
Okay. All right. So I think we've covered MKF and MKC pretty thoroughly, I think. Are you ready to move on to our third area of focus?
Yeah, let's dive in.
Okay.
This one's all about going beyond those traditional market indexes and really counting the market, but from a different angle.
Okay, you're talking about I think it's called market breadth and then customized indexes.
Right, you got it. So market breadth, it really focuses on the participation of individual stocks, but within the market, okay? Not just the weighted average of just a select few. Think of it as zooming out to see the whole forest, not just the tallest trees.
Okay, I like that. So instead of just looking at, like the Dow Jones or the S&P 500, we're looking at how the broader market is behaving.
Exactly, yeah. And one basic way to gauge market breadth is to actually look at what are called new highs and new lows. So if more stocks are actually hitting those new highs than new lows, well, that could be a sign of just genuine market strength.
Okay, so it's like we're checking the pulse of the entire market, not just a select group of companies.
Yeah. And your sources introduce a really intriguing concept here called eco-weighting. So it's a method for constructing an index, but where each stock's price movement contributes equally, regardless of its market capitalization.
So a small company, its price movement would have the same impact as a large company's.
Yes.
That's a very different way of looking at things.
It is. And it can provide some very, very valuable insights into the overall market sentiment because it levels the playing field.
Interesting. Okay. Now, when it comes to customized indexes, I think the sources mentioned that we can actually create our own.
Absolutely. Yeah, you can actually define your own criteria, and you can build an index, but it would track like a specific sector, maybe an industry, or even a custom basket of stocks. You're not limited to relying on someone else's definition of the market.
Okay, that's incredibly empowering because it means anyone can really become a market analyst with a bit of creativity and some effort. But with all this raw data, how do we make sense of it all?
Well, your sources suggest using some familiar techniques, like moving averages, and they also mention something called a MAD to smooth that data and to identify trends within your custom index.
Now, MAD, that's another one of those terms that maybe some listeners might not be familiar with. Can we just define that one really quickly?
Yeah, good point. So MAD, it stands for moving average convergence divergence.
Okay.
It's a momentum indicator. And it basically uses the relationship between two moving averages to try and identify those potential buy and sell signals.
Okay, so by applying those techniques to to our custom indexes, we can start to see patterns and maybe even potentially spot opportunities that we might have missed otherwise.
Exactly. And that's the beauty of market breadth and customized indexes. They allow us to see the market through, through a unique lens. And it's about uncovering insights that might be hidden from plain view.
This is really exciting stuff. It feels like we're starting to build a powerful toolbox for understanding the market.
We are. And the best part is that it's a journey of continuous learning and discovery.
That's great. So we've explored MKF, MKC, and market breadth.
Mm-hmm.
These are three distinct but interconnected approaches to market analysis. Can you help us connect the dots? How do these pieces all fit together?
That's a great question, and that's what we're going to delve deeper into in the next part of our deep dive.
Okay, sounds good. We'll be back after a quick break.
All right.
All right, so we laid the groundwork. We've talked about MKF, MKC, and market breadth. But how do these techniques actually work together? I mean, to create a more comprehensive market analysis strategy. I'm curious about that.
It's really like, assembling a puzzle, Each piece contributes to that overall picture. Imagine you use MKF, that traffic light system that we talked about, and you use that as your initial filter. So it gives you a basic sense of those potential buy or sell signals, but based on those moving average crossovers.
So we're starting broad. We're looking for those big picture trends.
Exactly. And then you layer in MKC, that nuanced market classification system. And by identifying that current market state, whether it's like a strong uptrend or maybe it's like a choppy sideways market or something in between, you can really fine-tune your approach that way.
Okay, so if MKF flashes a buy signal, but then MKC tells us that the market is actually in a weak downtrend, well, we might think twice before jumping in. It's about adding context to those signals.
Precisely, yeah. And this is where market breadth comes in. Remember, it's about looking beyond those major indexes, and we're assessing the participation of individual stocks.
Right, like we're checking those vital signs of the broader market, and we're seeing if it's confirming those signals from the MKF and the MKC.
Exactly. So let's say MKF gives us a buy signal.
Okay.
MKC suggests that we're in a solid uptrend.
Okay.
And then we look at market breadth and we see that there's a healthy number of stocks that are hitting new highs.
Okay, now that's a confluence of signals that would give me a lot more confidence.
Yeah, it's like getting that confirmation from multiple sources. And
right.
don't forget we can create those customized indexes to track specific sectors or maybe even specific groups of stocks that we're interested in. So this provides even deeper insights.
So it's about building this multi-layered approach, using these techniques to really corroborate each other and sort of paint a more detailed picture of the market conditions. I'm starting to see how powerful this can be.
It is. But before you get too excited and start placing trades, there's one really, really crucial step that your sources emphasize, and that's backtesting.
Okay, remind us what backtesting is and why it's so important.
So backtesting, you're basically running a simulation of your trading strategy, but you're using historical data.
Okay.
It's like having a time machine for your trading decisions.
Oh, so we can see how it would performed in the past under different market conditions.
Exactly. And it's incredibly, incredibly valuable because it helps you identify those potential flaws that might be in your strategy before you actually risk any real money.
So it's like a dress rehearsal for our trading plan.
Yeah.
We can iron out any wrinkles and make adjustments.
I like that analogy. I like that. And backtesting, it's not just a one-time thing, Your sources actually suggest that it should be an ongoing process.
Which makes sense because markets are constantly evolving.
Right.
So our strategies need to adapt as well.
Right, exactly. And you might find that a strategy that worked well, that performed well during a certain period, well, it might actually struggle during a different period.
Yeah.
So backtesting helps you refine that approach. You can tweak those parameters. You can make sure that your strategy is robust enough to handle different market scenarios.
So we're not just blindly following signals. We're constantly testing, analyzing, refining based on real data. This is starting to feel less like gambling and more like a science.
That's a great way to put it. And speaking of science, your sources also touch on some interesting concepts related to advanced money management. They mention compile and return and max drawdown. And I know those terms can sound a little bit intimidating at first.
Yeah, I was wondering if we could unpack those a bit. What do those terms mean? Why are they important?
So essentially, they're key metrics that are used to evaluate the performance of a trading strategy. Compile and return, it basically measures the total profit or loss that's generated by your strategy, but over a specific period of time.
Okay, so it tells us how much money we've made or lost using our strategy.
Yeah.
What about max drawdown?
So max drawdown, that's a measure of the largest peak-to-trough decline in your portfolio's value.
Okay.
But during a specific period. So it basically tells you how much you could potentially lose during a downturn.
Oh, okay. So it's about understanding that downside risk of our strategy.
Exactly.
Not just the potential upside.
Precisely. And by analyzing these metrics, through backtesting, you can start to get a sense of the risk-reward profile of your approach.
So a strategy with like a high compile and return might sound, really appealing at first.
Yeah.
But if it also has like a massive max drawdown, well, it might be way too risky for some investors.
Right.
It's about finding that balance between the risk and the reward.
Yeah.
That aligns with our individual comfort levels.
Exactly. And your sources actually suggest that more sophisticated money management techniques can help you fine-tune that balance even further.
Okay, they mentioned concepts like Kelly criterion and Monte Carlo simulation. I have to admit, those sound pretty advanced.
They are. But the key takeaway here is that there's always more to learn. As you gain more experience, as you gain more confidence, you can delve deeper into these more complex concepts and continue to refine your approach.
It's like leveling up in a video game.
Exactly. Yeah.
You start with those basic tools and those basic techniques, and as you progress, you can unlock those more advanced strategies and insights.
Yeah, it's a journey of continuous learning and improvement.
So we've covered a lot of ground in this deep dive. We talked about specific techniques, MKF, MKC, market breadth. We've explored how those techniques can be combined, how they can be back-tested to create a more robust and adaptable trading strategy.
Yeah, and we've touched on the importance of money management, risk assessment, and just the idea that there's always more to learn and more to explore.
But I think it's important to bring this back to our listener. We've thrown a lot of information at them. What are the key takeaways that they should walk away with?
That's a great question. I think the most important message is that understanding the market is a process. It's not a destination.
Okay.
There's no magic formula or guaranteed path to success. It's about building a framework for analysis. Using these techniques as tools to really guide those decisions and to manage our risk.
It's about being adaptable.
Yes.
Constantly learning, constantly refining our approach as we gain experience and knowledge.
Absolutely.
Okay, I think you've summed it up perfectly.
Yeah.
But before we wrap up this deep dive, I'm curious to get your take on something that the sources touched upon, this concept of a healthy market.
Okay.
How would you define that? And what indicators would you use to assess a market's overall health?
That's a fascinating question, and I think it deserves a deeper exploration. So let's dive into that in the final part of our deep dive.
Okay, so let's talk about this idea of a healthy market. I mean, it's a term we hear a lot, but what does it really mean? What are the signs that a market is truly like robust and not just, about to fall off a cliff?
Right. It's a question that's fascinated investors, for generations, really. And there's no single universally accepted answer. But, your sources offer some really intriguing clues, especially when it comes to this idea of market breadth.
Okay, so we're back to that idea of looking beyond those major indexes and really looking at the the participation of individual stocks. How does that relate to a market's overall health?
So imagine a market where those major indexes, they're hitting new highs, but underneath the surface, a lot of those stocks, they're actually lagging behind or they're even declining. That could be a sign of, like a narrowing of market leadership, which can sometimes actually precede a much broader downturn.
It's like a party where, only a few people are having fun and everybody else is just like feeling left out.
Yeah.
Not exactly a recipe for a sustainable celebration.
Exactly. A healthy market, it's typically characterized by this broad participation, with a good number of stocks that are advancing together. That really suggests a genuine strength and conviction, not just a narrow rally that's driven by just, a handful of high flyers.
So using those those new highs and new lows indicators that we talked about earlier, that can give us a clue about the underlying health of the market.
Absolutely, yeah. So if we see that more stocks are hitting new highs than new lows, that's generally a pretty positive sign. It suggests a broad-based strength and momentum. But conversely, if new lows are actually outpacing new highs, even if that overall index is, flat or slightly up, well, that could be a warning sign that things might be turning sour.
It's like a canary in a coal mine, just
Yeah.
a subtle indicator that there might be trouble brewing just beneath the surface.
Exactly. And another key factor to really consider is the relationship between price and volume. So in a healthy market, those rising prices they're typically accompanied by this increase in volume, and that really indicates this strong buying interest, this conviction.
So if prices are going up, but that volume is dwindling, well, that might be a sign of a weakening trend.
Exactly. It's like a car that's running out of gas. It might still be moving forward, but it's not going to get very far without more fuel.
And this is where those customized indexes that we talked about can come in handy, right?
Yeah.
We can create those indexes that track, specific sectors, specific groups of stocks that we're interested in, and then analyze the price and volume trends within those little niches.
Exactly. Yeah, it's like having a personalized market health checkup.
Yeah.
You're not relying on somebody else's definition of a healthy market. You're defining it. You're defining it based on your own criteria and your analysis.
I love that. I love that idea. That's great.
Yeah.
Now your sources also touch on the role of volatility in market health. So is volatility always a bad thing?
Not necessarily. Some level of volatility is it's natural, it's even
Yeah.
healthy. It creates those opportunities for profit, and it keeps that market dynamic. Think of it like, the waves in the ocean. They're a natural part of that environment. And skilled surfers can actually use them to their advantage.
But too much volatility, I imagine, can be unsettling and can make it difficult to execute a trading strategy. It's like trying to, surf a tsunami, not exactly a recipe for a relaxing day at the beach.
That's a great analogy, yeah. So that excessive volatility, especially when it's driven by, fear or uncertainty, that can make it really, really challenging to just stay the course. Even if your analysis is sound, it's like trying to navigate a ship through a storm. You need a steady hand. You need a clear plan if you want to avoid getting tossed around.
So finding that sweet spot of volatility where it's not too high and it's not too low, that's key.
Exactly, yeah. And that sweet spot, it's different for every single investor. Some people thrive on volatility, while others just prefer much calmer waters. It's about understanding your own risk tolerance and aligning your trading strategies accordingly.
This has been really, really insightful. I feel like I have a much better understanding of what to look for when I'm assessing a market's health. But as we wrap up this deep dive, I want to leave our listener with one final thought. We've explored all these techniques, all these frameworks for analyzing the market. But ultimately, it's really up to each individual to define what success means to them. It's about, setting clear goals, understanding your risk tolerance, and then using these tools, using these techniques to help you navigate the market's complexities and work towards those goals.
Beautifully said. And remember, it's a journey, not a destination. There's always more to learn. There's always more to explore. There's always more to discover. So stay curious, keep experimenting, and never stop challenging those assumptions. Who knows what hidden treasures you might uncover along the way.